All right, everyone. We've got quite a lot of people here, so welcome. Thank you for joining. We are excited to present you this amazing opportunity in Houston called the Country Club Apartments. This is a conjunction between Fairwinds Capital and J2K as a sponsorship team, and we are going to be addressing all the deal details and going over the whole team and going over the whole project. And I just wanted to go over a couple of housekeeping things. We've gone ahead and muted everyone when you join, just to keep it easy and quiet. But if you are welcome to go ahead and ask your questions in the Q&A section, put them in the chat, raise your hand, and we can go ahead and address them at the end in the Q&A section of the slide, or we can even address them as they come up, as they pertain to a particular slide if we're on it. So we would love to give you the opportunity to talk and be a part of the whole conversation, and we'll get to those at the end. But if you've gone over any of the details that we've presented so far, if you have any questions that as they come along during the presentation, please feel free to go ahead and put them in the Q&A section or the chat. And just make sure you are sending it to host and panelists, or if you want to address everyone, maybe you have the option to go ahead and change that as well. So without further ado, let's get started. This is our legal disclosure statement. Don't want to get into trouble. So just letting you know that we are going to send a PPM out, a private placement memorandum, with all the details about the deal. And this is not legal investment or tax advice. We are not advisors. And this deal is a 506c. So it is only for accredited investors as per the SEC rules. So if you have any questions around the legal or tax implications, please feel free to talk to your own individual advisors around those specific things. So for the agenda today, we've got introductions for the team. We're going to talk about why the Houston market. We're going to go over all the deal metrics around this particular asset, the project, the renovation plan that our amazing property management team has put together with amazing experience behind them. We're going to have our finance team go over the capital stack, the debt structures, and then we'll come back and go over all the next steps and how you can get invested and started. I will go ahead and pass it along to Jonathan New to take over the presentation.
Thanks, Jaspreet. I'm Jonathan New. I'm the director of Fairwinds Capital Investments. We are a group that's formed by naval and maritime officers. And so in the Navy, when a person detaches a command, we wish that person fair winds and following seas. Basically, it just means that I wish you a safe and prosperous journey, which is exactly how we set up our business plan and the way we strive to make our investments safe and prosperous. Simple as that, and it just ties back into our roots. So the team is what makes your investment chug. So we talked a bit about myself. I'm originally from Alabama, went to Auburn, War Eagle, but don't hold that against me. And I've spent the last 18 years in the Navy. I am a commander. I am on my last tour of duty, called my Twilight Tour. And I've been in real estate for 14 years. The first part of it was residential, and then I figured out that commercial was the best place to be. And then I started doing business with Corey Vadim and Jaspreet a few years ago, and we decided to make it formal and created Fairwinds. Corey Chonsky is our director of commercial real estate. He's been kind of the lead on this project, just doing a fantastic job. He can't be here tonight, but he is a lieutenant commander in the Navy. He is recently retired, and he spent 22 plus years in leadership. And so he is an absolute rock star. Vadim he's the unicorn. He got into commercial real estate right off the bat. And he is a lieutenant in the Navy, and he's about to get out. He has 1 month left, and then he will be joining us for absolute full time. Jaspreet is your MC for this fun event, and he is based out of California. He has an amazing mind for numbers, people connection, and just anything and everything you need. He is a jack of all trades. He knows it all. And I'm going to turn it over to Jim to talk about J2K.
Thanks, Jonathan. I appreciate it. And I want to say that we are very proud and excited to team up with a senior group of officers in the Navy that have been trained by the very best. And I think it's going to be a great relationship on a great deal. And I am Jim Biggs, and I want to introduce J2K. I am founder of Jeroma Enterprises and the GOB Network. I'm a lifelong entrepreneur, having owned and operated many businesses spanning new car franchises, the steel industry, and real estate. And Julie is our finance expert. As a senior advisor at one of the largest lenders in Texas for apartment communities, she brings expertise and an inside track for our capital stack, ensuring that all the most important decision on these types of deals, your lender, that we get the right product for the right deal. And Kimra Holcomb, we chose Kimra as our property manager for this project. And she owns a nationwide firm that is vertically integrated. And she's managed in all asset classes and in most sectors, including senior living, student housing, and of course, multifamily. In fact, she liked the deal so much that she decided to join us as a general partner, and we couldn't be more excited about that decision. And J2K is a veteran team of investors, entrepreneurs, business owners with over 100 years of real estate experience, spanning all asset classes nationwide. And we focus on business management, sales, marketing, finance, deal structure, and community development. And our lifelong goals and interest in real estate drives value for our limited partners and also for our personal investments in the multifamily commercial real estate space. So I'm sure most of you have heard that the most important factor when deciding to invest in a deal is the sponsor team and their experience. You know, how many deals have they done? How many have gone full cycle? And most of the deals that you see today are sponsors who have exploded into the space on social media within just the last 3 to 5 years. But you can see from the slide here that the team of J2K has over 100 years of real estate experience, and we've been in over $625 million worth of transactions, and that we are actively invested in 32 deals with over 6,700 units. And we've gone full cycle on 29 deals at close to 6,700 units. And Kimra in particularly has a renovations division of her company that has over $123 million of renovations completed, and an average value added compared to cost of returns that almost 64%. And I want to speak a little bit about the Houston market. So Houston is the 4th largest city in the United States with 2.3 million people. It has a population growth that's about 1.5% per year. The job growth has been at 1.3% over the last year and projected at 17.5% growth in the next decade. So explosive growth in job growth. Rent growth in our particular submarket, the Northwest Houston market, has a 3-year average of 4.1%. And in our submarket, we have an average household income of $54,696. And the average house value is $230,000, trending upward at roughly 4%. And this pie chart is here more than anything just to demonstrate the diversity of the jobs in our submarket. So you can see we don't have an outsized dependence on any one sector of the economy, but there is one sector that that really leads our submarket, which is the medical sector. And there's a lot of medical jobs in hospitals and everything ancillary to that in the medical field, very, very close to this asset. And they really haven't been targeted. And that is going to be one of the primary areas that we try to focus on to help with that tenant base, and that will be attracted to the type of upgrades that we're going to be doing on the property. And I also want to speak very briefly about Texas as a whole. which is that the Texas Triangle, of which Houston is one of the three anchors to the Texas Triangle, is the third largest market in the nation for absorption. And Texas has 3 of the top 7 markets in that, and they're all part of that Texas Triangle. And Houston has also over 23 Fortune 500 companies in the Houston market. Many of them we're all familiar with, especially in the oil and gas sector. But it also ranks second in the nation in overall population growth between 2010 and 2020, with Greater Houston's predicted to be over 10 million people by 2040. And it's was the fastest growing city in America, according to BizNow, at the beginning of 2019. And it was also voted as one of the best places to live by the Wall Street Journal in an article, and #1 best market to purchase multifamily assets, according to 10X, and the #1 best city for millennials, according to the Langston Company. So I think that we've got you a wonderful asset in a wonderful community. And Jonathan, I'll turn it back to you.
Thanks, Jim. So obviously we have just an amazing team and an amazing market. So she is a 1977 build, which we've had fully inspected. Kimmer has an amazing plan for the renovations, but it does match the 2 beds. It's mostly 2 beds. So it matches a very upscale family tenant base that fits in with our family mindset of Fairwinds. It's very close to the interstate. It's got the pitched roofs and individual HVACs that we've got repairs planned for and budgeted for, and it's a great size of living space for the families that are going to be living at Country Club. Here's where it sits in the Houston market. It's just north of the airport, and it's like I said, it's a B-class area that we're very excited to invest in. Surrounded by medical facilities, it's also next to a great shopping. Starbucks is invested there. I love Starbucks. Corey and I have been out there a couple times, always hit up the Starbucks. Ate at the Texas Roadhouse. Love the area, to say the very least. Like Jim was talking about with the diversified employment, the medical facilities nearby, the Kroger, obviously it's near the airport. And when we're talking Texas, you can't not think about the fuels. An inelastic good that's not going anywhere. So deal metrics, let's talk some meat and potatoes here too. Okay, so we're raising $6.6 million. We are doing an 80-20 split after we meet your 12% hurdle with the waterfall, which I'll talk about in a minute. But the 12% pref return, very rare. You're not going to see this. We wanted to stand out from all the other noise that you're getting from all the other syndicators. So we're offering that 12% because we're that confident in this deal. We anticipate a refinance at year 3 to return 65% of your capital. And then we have that 3 to 5 year market dependent business plan, 1.85% target equity multiple. And then on year 1, we're estimating a cash flow of about $180,000 with an IRR of 17.5 and a $12.25 million purchase price. These are just terms. It's a 506C, so everybody's accredited. You know what you're doing. But this is just a slide for your reference, just in case you don't know what a waterfall is or an IRR is. Everybody knows the term IRR. Not many people know how to calculate the thing. Waterfall, you win first. We all win second. So 12%, like I said, it is above market. We wanted to make sure that it is exciting for people. After that is an 80-20 split all the way up until we hit 18% IRR. After the 18%, we get to trade off to that 50-50 split to make sure that everybody is happy after the 18% IRR. So as an example, if you were to invest $100,000 We start off with a $3,000 return. So obviously the cash on cash in a heavier lift renovation plan is going to start off a little small, and then it's going to grow exponentially. Kimra's team is fantastic. They've done this before, and they're going to be cranking it out, starting off at 3,000 to the 8,000 in year 2. And then we have a cash flow of about 13.5% in year 3 with a return of your investment of 65%. And then after that, it's going to switch to a little bit less cash flow, but you have more money in your pocket. So your cash on cash is a lot higher. And then we'll exit in year 5. So for the business plan, we are going to start our renovation process as soon as possible after closing. It is entering the holidays, but we're going to be starting off with the transition and stabilization of the property and renovations. And then once we get to the stabilization point, we are going to refinance, and then we are going to sell at year 5. It's all market dependent. So for them, some of the value add highlights, we're anticipating on increasing the NOI by $740,000. And as it is right now, it is a gross income of $343 below what the market has proven we can attain. And that is after we renovate, though. We're going to drive up economic occupancy and down the vacancy. And we are obviously starting our underwriting at a very high economic vacancy. So the one thing that we strive to do is provide the highest value with Fairwinds, to our deck plates, to the sailors, to the people that look up to us as senior leaders in the Navy. And we also want to do the exact same thing to our tenant base to make sure that they have the highest quality of life that they possibly can get, which includes making sure that their environment is well taken care of. We're going to be doing LED conversions and water conservation programs to make sure that we're not wasting natural resources. Also drives down the expenses, which is also good for valuations of properties on refinances and sales. And then we're also looking to do some additional income sources, such as like entertainment packages and wireless packages, which have not been taken into account of the business plan. Our capital stack, purchase price 12.25, renovations at 4.31, closing costs $728,000, acquisition fee $331,000, reserves obviously important, $134,000 at $1,000 a door, and then the total cost 17.75. The debt, we are currently at 11.18 or $19 million for the debt, and then our capital raise is just under 6.6. That's how we're going to be spending the money. I'm going to turn it over right now. Who's going to blow your socks off? Kimra Holcomb.
Thanks, Jonathan. Hello, everyone. Well, as you saw earlier in the presentation, the combined team has an extraordinary level of experience, and that does not stop with our Vicinity Property Management team. I'm the founder and CEO of Vicinity Property Management. I actually got my start in multifamily in Houston, Texas, way back in 1977. Yes, I know, I started when I was 8. Anyway, while I alone have 40 years of multifamily experience, my executive level team combines for over 250 career years in multifamily property management. Our experience spans across 48 states, all asset classes, institutional, as well as syndications in the private sector. Over the past 10 years, we've completed our robust due diligence process on 109 properties, nearly 25,000 units. We've managed full cycle 107 properties, over 22,000 units. And as Jim mentioned early on, over 120 million in value add renovations. In 2019, we actually exited the Houston market, selling our remaining 4 properties. We had 800 units there. And quite frankly, we've been itching to get back into this market ever since. Over the course of my career, I've managed or been on the LP side or ownership side on over 45 properties in the Houston MSA. So we know this market well. Today, we currently manage 34 properties, just over 4,400 units in 8 states. So experience delivering successful value-add repositionings, that's the name of our game. Our approach is based on science, not just gut instinct or what you might watch on HGTV. 15 years ago, we actually started a journey to become a one-of-a-kind brand. Our goal was to align the operation strategy with the investment strategy that would enable higher profitability across all multifamily asset classes. And we found that segmentation and brand were actually 2 key enablers which could fulfill on this strategic intent. We mobilized an initiative to identify, define, and deliver definitive customer segment priorities to enable a customer-centric approach. One of the main objectives was to build living experiences so powerful that our residents and our prospective residents would actually become our sales force. This approach involved a shift from an industry-wide asset-focused investment to a unique experience-based investment with a clear sense of purpose. Our team's primary focus is creating value through management and redevelopment of high land value assets in good locations. This implies serving residents with different value propositions. As it turns out, aligning operations with the investment strategy did require customer segmentation to maximize the value. And to unlock the full value potential of each investment we go into, we slate each of our deals into one of our 4 identified customer segments. We actually call these our customer collections. After our in-depth market analysis of the Country Club apartments, and by the way, soon to be rebranded, we decided it would best fit within our town collection. The town collection resident segment is seeking a peaceful reprieve, a home without the house. And this Houston location, specifically the Cypress Station submarket, is ideal for this demographic. The renovation plan has been customized for a perfect fit in this market and for this resident. They will receive an incredible value for the interior and exterior upgrades we've carefully selected for them. Our clear sense of purpose affects everything from our acquisition selection to the redevelopment scope and CapEx spend, all the way through our operating processes. This competitive advantage is proven. We have followed this approach for 15 years, and it has continually worked over and over again. And all those redevelopment projects we've completed, that was like on 50 properties, exteriors, interiors, and in fact, like 10,000 interior apartment renovations. We actually applied this distinctive and compelling approach. This methodology allows us to be selective on our acquisitions, have a more targeted investment, drive stronger financial performance, greater returns, premium price points, a more consistent cash yield, and significantly improve operating margins. This is how we plan to deliver. Here's a visual representation of our most recent Houston experience. You can see on the map that we even had a property in the same neighborhood as Country Club. Country Club's the little blue square in the top part of the map. We actually had a property within a mile of Country Club that we exited just right before COVID. We had decided to test that Houston market, and the whole Houston market, our last round of exits, actually delivered over 50% growth in cost to a purchase price. For this deal, Country Club, we positioned $4.31 million renovation budget. These will be targeted and well-spent dollars. The renovation work spans 24 to 28 months to completion, with stabilization occurring by end of year 3. While our town collection research informs most all of our decisions, the comps in the market have already been blazing the trail with similar upgrades. And our comps have already proven out our targeted rents. This is an ideal scenario. We've slated the renovation projects into 4 buckets. 1, life safety. 2, environmental initiatives. 3, interior renovations. And 4, exterior enhancements. Now let's break these down. Life safety. From addressing deferred items such as fire safety and perimeter fencing repairs, we'll also focus on safety and security with repairs to the gated access, which will include adding license plate readers at the entrance and exits, as well as adding cameras throughout the community. The second bucket, environmental and eco-friendly projects. A property-wide green rewards program will include water conservation and LED lighting upgrades. We will reduce the water consumption through low flow water saving devices, as well as minimizing electricity, minimizing electricity usage with LED lighting fixtures on the exteriors and on the interiors. In addition, we'll be installing 2 new high efficient boilers. The Houston summers are long and hot. And as you will see in our exterior renderings coming up, we're incorporating the current window awnings to align with our aesthetic design because they also work double duty in conserving electricity when it comes to AC. Another green avenue is that we're planning to install black window screens. They don't actually impede the view from inside the apartment, but they do dramatically reduce the heat by reflecting it outward and away from the apartment. Our modern interiors do include a smart home package with smart thermostats and locking systems, all controlled with your smartphone. The interior renovations, our town collection interiors include installing washer dryer connections in all the 1- and 2-bedroom garden flats. The townhomes already have washer and dryer hookups. This includes, we will be installing washer and dryer appliances as well in all apartments. The 1-bedrooms will have a stackable washer and dryer installed, and we'll be installing full size in the 2-bedroom flats. These appliances, along with the stainless kitchen appliances, will be ENERGY STAR certified. The kitchen will have a new modern wood shaker cabinets with soft closed doors and drawers. The contemporary backsplash will be anchored by gorgeous stone countertops. All kitchens will be equipped with USB charging plugs and upgraded with really cool plumbing and lighting fixtures on the ceiling. The bathrooms will have the same finishes: shaker cabinets, stone countertop, plumbing and lighting fixtures. We'll be installing beautiful wood-inspired flooring throughout the apartment, which will be complemented by the designer 2-tone paint scheme. And the energy efficient selections, along with the smart technology elements, will elevate the living experience. A home without the house. Perfect for the town collection. The exterior enhancements. The rebranding will be inviting to our town collection customer and will carry throughout the entire community. Look and feel. A complementing new paint scheme to the exterior buildings, an overlay of the drive and parking areas, landscaping, and enhanced curb appeal will all be our initial hello curb appeal. To further lift the living experience, we'll be adding a 24/7 fitness studio by converting one of the current laundry rooms, and we'll be also adding an outdoor kitchen grilling area. Both of these will overlook the sparkling swimming pool. It will be very, very comfy to lounge, relax on the new furniture that we position around the pool as well. We will take pet friendly to new heights with our new pet park and play area for our furry friends. And for our residents with children, a fun new playground center will be added with benches situated under this beautiful big shade tree right near the playground. Perfect for mom and dad to sit in the shade while the children play on the playground. For convenience and a differentiating experience, we will be installing a 24/7 resident package center. This will also become a revenue generator for us as well, while we're making life easier for the residents who will be living there. So exciting. The inspiration boards, I'm going to walk you through here a few boards that we created to provide inspiration as we were going through our due diligence and our market analysis. The inspiration board that you see on the screen right now was part of our journey in selecting colors and feel for our path forward. And remember, we had to keep in mind the color of the awnings that were already installed at someone else's expense, but we didn't want to just remove those because they do add an energy efficiency to the property. The next slide, the draft renderings page, provides a current look with our new exterior color aesthetic. Each of the photographs, each of the renderings that you see has the actual photograph in the bottom right corner of the current in place look today. So you can see the contrast between what's there today and where we plan to take the community. The amenity inspiration board demonstrates some of the things that we've actually done on some of our other town collections in the past, but which we'll be doing at Country Club. The pet park, the resident package locker, there's an example of one on the screen as well, fitness center, new playground, outdoor kitchen, grilling area, really cool stuff. And the interior design board are actual photographs of other town collection renovations that we've recently completed. This captures some of the elements that I've described to you here just during this piece. And you can see the washer and dryer, the stone countertops, the white shaker cabinets. These are all very similar to the features that we will be installing at the Country Club. And this is how we plan to deliver. And with that, I'm going to turn it over to Julie Peterson to discuss the capital stack structure. Take it away, Julie.
Thank you, Kimra. Today's lending environment has shifted to bridge financing to support exceptional opportunities like this Country Club Apartments. A bridge loan gives us the ability to roll in a significant amount of CapEx dollars required to turn this opportunity from a Class C to a Class B into the loan that has more favorable terms available. So this amazing product, this bridge loan that we're going to be using, provides us 3 years of interest-only financing to get us our robust business plan achieved. And then we're going to be raising $6.6 million in common equity, which we look to you to help us with. And then after 3 years, we're going to look to extend this loan either another 2 years if we need it, or we're going to really look closely at the operations to see if we should hold on to this current loan or cash out or maybe even sell. We've underwritten a cash out refinance in year 3, and we will pick up an additional 1 year of interest only if we decide to go with agency. We're going to be using 75% leverage and a strong step down, which will allow us to exit this with minimum down prepayment penalties.
Fantastic. So we want to make sure that we put our interest aligned with yours. So we are leaving our acquisition fees into the deal. We're not going to get those back until we get the refinance. So we're also making sure that we don't take our fees until we've met these returns that we're targeting. We're also leaving in 10%, or we're putting in 10% of the required capital close coming from the GP, the equity splits, the waterfall. It's all meant to make sure that we're performing for you guys, that we're putting up our entire net worth and liquidity when we sign for the deal. Is non-recourse, but it also doesn't mean that the bank can't find some legalese to come after us if something bad happened. So we've got a lot at risk to make. And then for our fees, we're doing 2% acquisition fee, asset management fee, and then disposition, and 5% of the rehab budget for the construction management. For economic vacancy, we're making sure that we're very, very conservative. Year 1 is at 30%, stabilizing it at 10% in year 3, which is still above Houston submarkets, specifically this submarket. For Northwest Houston, they're looking at 4.1% year growth according to CoStar. And then we're modeling well below that for income. And then our increases for expenses are right there as well. And then for the additional income, the current owners aren't really capturing their priority parking. So we're going to be getting a more efficient way to capture that from the tenant base, as well as our water conservation program, increasing the RUBS. Here is an example. Here is what it looks like, how we're going to increase our revenue over the next 5 years while becoming more efficient with our expenses, thanks to an amazing property management group. And you can see what's going to happen to our NOI as we increase both of those. So obviously got to think about taxes, because taxes, they're thinking about you. So we are going to be doing a cost segregation study up front to make sure that we can pull all of those tax benefits that make real estate the best investing platform out there. And we're going to make sure that we capture as much of, to make sure that it's very beneficial to you up front. Here's how we can accept your investments. It is a 506c offering. Our minimum investment is $50,000, and we're closing in November. So the quicker you can get your subscriptions in, the better, because it is obviously first come, first serve. I want to open it up to questions and answers. We have a few. And also to reiterate, here are the terms that we are looking to target for this particular investment opportunity. So questions and answers, let's do this.
Well, I know we saw a question coming in from Stony, I think at the very beginning, around what is the average household income or the median household income locally. Kimra, I'll go ahead and let you take that one.
Actually, I think Jim answered it in the chat. Jim? No, I thought I saw he answered that. So the Houston MSA is sitting right around 52. Oh, it was actually David, one of the attendees, answered the question. The Houston MSA sitting in 2019 was sitting around just over 52,000 as a median household income. And David, I know pulled another statistic. I'm not sure in what submarket that was, but we can definitely talk further and pull other research. But what we pulled recently from CoStar 2019, it was just over 52,000.
Thank you, Kimra. And if we look at our Q&A section, Kathy had asked, what's the minimum investment amount? I know we just addressed that at $50,000. And Trevor, you had asked about boots on the ground. I know that Kimra has got an amazing team set up, ready to go. And Kimra, I know you were talking about how you have an ex-regional manager who are now bringing onto the property as on-site property management. So that is some extensive experience, an amazing resource who's got all the details, knows the submarket really well, has managed multiple assets in the neighborhood, and is now being brought onto the property. So that is going to be a crucial resource for us with boots on the ground, and we're going to have an entire team built out to manage this asset and more. So we've got that covered. And then Benjamin, how long are you expecting the reposition to take? Jonathan?
So the reposition should take, we're anticipating 3 years to stabilization. Realistically, it should be sooner than that. So we're just trying to be conservative. Kimra has talked about between 5 and 6. She's capable of 5 and 6 units a month, but obviously we're trying to make sure that the cash flow is still there while we reposition each unit. And we're and the lease, as leases come due and we transition to getting tenants out and repositioning those units. So short answer, 3 years. Realistic answer, sooner than that.
Excellent. Thank you. And then Art had asked about what are the current rents and projected rents. Kimra, I'll let you take that one. Oh, you might be on mute.
Yes. So the current rents in the at the property today are sitting about between $200 to $300 below our target rent, depending on the floor plan type. And that's just the rent specifically, to answer your question.
Yeah, we've targeted other income sources, expense reductions. So there's quite a bit that goes on. So our total revenue difference from current to future is a lot larger of a gap than the $200 that Kimra just mentioned. But yes, there is room to grow in the rent rate itself, along with other income sources per unit.
And to quote the dollars, Jaspreet, it's the average rent is about $855, and quite frankly, it looks like the appraisal's coming back for the market to validate our findings at $1,250 an average per unit on an average basis. So that's, you know, darn near 400. It's really growing quickly.
Excellent. All right. Benjamin asked about getting access to the underwriting. I think we can discuss that offline and see what is easily shareable. We've got our own legal team to get through before we share all the data, so we will let them handle that. And then David is asking about how are we justifying a lower property tax projection?
Actually, we aren't targeting a lower tax projection. The model, we'll make sure certain you have the most recent model, because I think a seller is currently was at 230 a year. Our model is now sitting at 295 on year one.
Yeah, and we've got lender guidance built into our underwriting as well.
Exactly.
To make sure that we are meeting at least their expectations, if not being more conservative than the lender is asking us to be. So we are good to go on that end.
Yeah, and we're still gathering. I mean, we know this market, we know the property, but we're still digging in and trying to look for every little thing we can go after and attain. So yeah, the revenue piece is really pretty strong coming. So catching that tax piece. Also, Houston, back to the taxes, I'm sorry, Houston is not a market that records tax on the sale. That's why we were keeping that tax pretty flat, because that's our experience in this market. And the lender came back and said, hey, you know, we understand that, but you know, our underwriters say to put it in. So we actually re-looked at it and then added it in for the lender.
Yeah, the non-disclosure state definitely helps.
Non-disclosure. Yes, non-disclosure.
All right, hopefully that answered that question. And then Kevin is asking about what's the current vacancy and the year one planned vacancy. I think we can differentiate between physical and economic. I don't know if either Jonathan or Kimra, either one of you can take this one. Well,
their current vacancy is quite high. They're 98% today. They haven't been this entire year, but they have a pretty good manager in place too, that just recently started this in 2021. But they're sitting pretty high. That's why we're spreading our redev plan out, because it's not like we're walking in and we've got, you know, 10% of the property that we can just immediately start renovating. So our planned vacancy is for physical vacancy is to hover in the low 90s once we start renovating, so that we can have constant product to keep the pipeline full and the leasing happening. We're just going to turn.
And I know that Jonathan, you had mentioned about keeping our economic vacancy pretty high conservatively the first year. You may want to talk to that.
Yeah, no, absolutely. It's quite the balance to execute the business plan while or the renovation plan while maintaining the cash flow. We recognize that it's very important to have that cash on cash for our investors, which is what we're trying to achieve here. While we could just kick everybody out and then redo stuff, I mean, that doesn't make sense, and it's not providing the top value to the community that we're trying to achieve here.
Thank you very much for answering that as well. All right, and I think we have another question around how long did the seller own the property? That is again around taxes as well.
I want to say it was around 20 years is what the broker told us.
Yeah, it is a little misleading because if you do any research on the property and you look in CoStar, it looks like it recently traded too. So they made some kind of shift that was recorded, but they haven't disclosed what that shift was internally that they did. Mm-hmm.
All right, and I know that we've addressed quite a bit of things. So questions around taxes. What kind of a tax break are we expecting year one from the cost segregation study? Jonathan?
Fantastic. We're still talking to our CPA about that, but we're anticipating anywhere like north of 65% of bonus depreciation. We've seen anywhere between 70 and 100, maybe even 130% of tax depreciation. But realistically, we're thinking it's going to fall between 70 and 100% of the bonus depreciation. So
yeah, I think to be
65
conservative,
plus.
we're gonna stick to 65 for now and see
65.
what the actual study comes back with. Yeah. Excellent. All right, and I think we have another question around distributions. Will distributions be monthly or quarterly for the LPs?
Quarterly.
As soon as we are realizing cash flow from the asset in the very beginning, we are going to start quarterly distributions. And they will continue as long as the property generate cash flow, we are going to continue that quarterly distribution. As long as we maintain our reserves, key factor. Okay, I think we've handled, Kathy, I know you talked about the huge tax bump, but I think we've got our vendors in place as needed to go over, getting a break on the tax assessment increases if needed. We're working with local resources to make sure that we have a pulse on exactly what that bump's going to look like and how we're going to handle it. And like we said earlier, we're working with the lender already as well and their underwriting to make sure that we have captured the tax bump in our underwriting beyond what even the lender is asking us to do. So we should be in a good position. All right. Do we have any other questions around the business plan or any of the team members? Please feel free to go ahead and put them in the Q&A section or the chat. And if you would like, we would love to have you on The Voice. So please feel free to raise your hand and we should be able to bring you on live and you can ask your questions. Man, this has been an exciting opportunity to go through. I know that the whole team is definitely excited about this particular deal. We've seen the unit count is amazing. The submarket's awesome. We've got a lot of experience on the table here with the GP team. So we are definitely amped, excited, ready to go. and get this project underway. You've got the website that you can reach out to us. You've got the button for the Invest Now will be made available to you guys after the webinar, so you guys can go ahead and go to the portal and get started on the process to get invested. And Jonathan, Jim, Kimra, anybody else, I would love to go ahead and get some closing remarks.
I will just answer Kathy Leby's question, which is how did we find this? I have very good relationships with local brokers in the area, and it was offered to me, and I offered it to my team. So we're very excited. Again, it's all about your partnerships and your relationships. So this one came to us, so, you know, with you know, our relationship. So I would just say that I am excited to be part of a great team. Kimra has a lot of experience and, you know, second to none delivery. And I'm very excited to be able to share this with you. And if you guys have any questions on the lending side, I'm happy to answer those as well.
And I will also say that I am super excited to help on this deal and help sponsor Fair Winds Capital and have the J2K team on this deal. I think that if you're looking, I'll reemphasize what is often taught and said is you invest in the sponsor. That's the most important piece of the deal. And, you know, to have this much experience on a sponsorship team, this much experience in deals in the Houston area. And I do want to remind you, it's not the only deal that we have actively in Houston. So we've had many deals over the last decade that have sold, but we still have other active deals in Houston right now. And, you know, to get a 12 pref at the end of the year, nice Christmas present. And also cost segregation toward the end of the year. You kind of get an idea when you're starting to do your taxes, how much you're going to have to pay. So a lot of times you can take that amount of money and offset it by, you know, the cost segregation study with bonus depreciation. So really keep that in mind. You know, don't pay any taxes. If you're going to pay taxes, let's make sure we get you in on this deal and see if we can mitigate that. And remind everyone that it is a 506c. It is for accredited investors, but that also means that we can talk about this deal to anyone we want to talk about it to. And if there's anyone on the call that has a friend or knows someone else who would be interested in 12 pref or a big tax savings at the end of the year, I'd really encourage you to reach out. You know, there's no commitment to hit the Invest Now button. That doesn't really mean invest now. It means go on and register and give us an indication of your interest in the deal. You're not going to have to wire your money by hitting the button. So just go ahead and hit the button. Show us that you have some interest. And if you have any additional questions, you know, we have an email address set up for that at the invest@fairwindscapital or fwcinvestments.com. But you can also reach out to any of the sponsors that are on the deal that you know or that you feel comfortable asking those questions. And thank you very much again for taking an hour out of your evening. I know that everyone has really busy schedules and these things can be hard to attend, and just really humbled by how many people we had show up tonight. So thank you very much.
Definitely, I know.
From the Fairwind side of things, I just want to say that my illustrious partners have summed it up excellently. And after a lifetime of serving you with freedom, I want to serve you with a great investment opportunity. So that's it for Fairwinds. Thank you very much for coming.
Yeah, and I know we had another question about getting a slide deck and webinar recording. So please go ahead and sign up for our investor portal, and you will go ahead and get access to the recording and the slide deck as well. All right, we've got representation for everyone, and I really appreciate all of you guys coming out as well. We're going to go ahead and close this webinar out, and we look forward to hearing from you guys soon about this amazing opportunity in Houston, Texas with a strong team. So have a great night, everyone. Take care. Stay safe.
Let's do it.